Let's look at the data. Forget the headlines, forget all the noise. You know, the real stories, the ones that matter, they're written in the numbers. Today, we're diving deep into a major market anomaly, a real battleground, where you've got short sellers, huge institutions, and a company's fundamentals all locked in this high-stakes game. So let's read the tape.
So, what are you looking at right now? It's just a number on a screen, right? 34.97%. But you know, in the world of the stock market, a number this specific, this high, whoa, that is a massive signal. It's a red flag, it's a coiled spring, it is an alarm bell ringing loud and clear. The real question is, what does it actually represent?
And here we have it, this number. It's the short float for Applied Digital Corporation, ticker APLD. Now let's be super clear about what this means. Over a third of the company's entire tradable stock is being actively bet against. This isn't just some light bearish sentiment, folks. This is a colossal, concentrated bet. It signals extreme conviction from one side of the market, and that is a divergence that absolutely demands our attention. Okay, so whenever you see a number like that, the first thing that should pop into your head are the mechanics of a squeeze. And look, this isn't about heroes and villains. It's just about market structure and liquidity. So let's break down exactly what a setup like this really means.
First off, let's get precise so we're all on the same page. The short float is just the percentage of a company's shares that are available to trade that have been sold short. Simple enough, but a high short float like what we're seeing here, it creates this really unique situation. You have this huge built-in demand from short sellers who eventually have to buy back those shares to close out their positions. They have no choice.
And this is how that can create a powerful feedback loop. That high short interest, that's the fuel just sitting there. All it needs is a spark, right? A catalyst. Maybe some good news, or just a sudden burst of buying volume. As the price starts to climb, those shorts start losing money, and they're forced to cover, which just means buying back shares. But that buying action just adds more fuel to the fire, pushing the price up and forcing even more shorts to cover. It's a powerful, self-reinforcing cycle.
But, and this is a big but, here's where the plot thickens. If this were just about a heavily shorted stock with some shaky fundamentals, well, that'd be a pretty simple story. The data, however, is showing us a major conflict, a real divergence in what the so-called smart money is actually doing.
So here's the core of the conflict. On one side, you have this massive bearish bet from the shorts. But on the other, institutional transaction data is showing a net positive inflow of almost 9%. What that means is that large, sophisticated investors have been buying up shares. So the critical question becomes, why is the smart money so aggressively positioned on both sides of this trade? What is going on here?
This chart really lays out the battlefield for us. You've got this massive red bar of short interest, and it's being directly countered by that solid green bar of institutional buying. Now, this kind of divergence could mean a few things. Maybe we're seeing long-term investors just accumulating shares while things are volatile, or it could be a clash between different fund strategies. You know, quants shorting based on fundamentals versus long-only funds buying based on analyst ratings. Let's dig in and see how this conflict builds out two very different cases.
To make any sense of this, we really have to put on our analyst hats and weigh the evidence impartially. So let's break this down into a clear bull case versus a bear case.
All right, the bull case. It's really a technical argument built on market pressure and sentiment. The number one factor, of course, is that 35% short float. That creates some serious squeeze potential. And that's backed up by the institutional buying, which could act as a sort of price floor. And to top it all off, Wall Street analysts are overwhelmingly bullish on this thing, with a strong buy rating and an average price target way up at $42.90.
Now for the other side of the coin, the bear case. This is purely about the fundamentals, and frankly, it explains why all those shorts are there. The company's earnings per share are deep in the red. Recent performance, a decline of over 600% this year alone. Ouch. On top of that, it's trading at a really high price-to-sales ratio of over 35. So the bearish argument is pretty straightforward. The company's valuation just seems completely disconnected from its actual financial performance.
And that brings us right to the heart of the dilemma, doesn't it? What wins out? Do you bet on the intense, technical pressure cooker created by the shorts and the institutions, or do you bet on the cold, hard numbers on the company's financial statements? That's the question every single trader looking at this setup has to answer for themselves.
So what's the strategic takeaway here? Well, in a setup with this much conflicting data, you just can't afford to be driven by a narrative. You can't just pick a side and close your eyes. The professional approach is to stay data dependent. You watch the order flow, you watch the volume, you watch the price action for any kind of confirmation of either the bull or the bear thesis. Understand both the incredible potential for a squeeze and the very real risk of a fundamental-driven drop, and manage your risk with absolute discipline.
Stay disciplined, stay liquid. Just a quick and important reminder. This analysis is for educational purposes only. It is not financial advice. The data we went over today is from December 14th, 2025. And as you know, market data can change in a heartbeat, so please, always do your own due diligence before making any investment decisions.
We are tracking these institutional flows in real time. If you want to follow along and analyze the next move, check out the tools in the description. You can sign up for Public and get $20 in free assets, check out Webull for their BTC promo, or look into NVDA on Moomoo. All the links are down below. And hey, if you found this deep dive valuable, be sure to hit that like button and subscribe for more analysis.